Welcome to the 6th episode of Prime Q&A, where we answer our subscribers' queries. My name is Gaurav Menon, and we have with us our co-founder, Bhavana Acharya. Hello, Bhavana.
Hi, Gaurav.
So the first question today is, I have already invested some money in the ICICI Low Vol 30 ETF. If I want to invest more, should I add more ETF or buy more units in the fund of funds?
Okay, so the iPro Low Vol ETF does not have very high volumes, but its tracking error is still low. So it is able to maintain, how it tracks the Nifty Low Vol Index. And the FOF, now that it has come out, will help improve the volumes in that ETF. So you don't need to be too worried about the ETF. So the choice, if you already have the ETF, it's more a matter of convenience, whether you want the ETF or you want the fund route. So if you have already invested in the ETF, you retain those investments there, you can continue making fresh investments in the ETF itself, because like I said, the tracking error is low and the liquidity volumes should improve now that the FOF has come in. So you can invest in the ETF instead of adding another fund in addition to everything that you have. But if you want to run SIPs, say, and your broker doesn't allow you to run those SIPs, then you can use the fund. Or if your SIP amount is large, say it's more than say 75,000 or 1 lakh, then you can use the FOF again, because until the volumes in the ETF improve, it is easier to go with the fund. So if you have a huge SIP amount, then use the fund. If your broker doesn't allow SIPs in ETF, then you can use the fund. Otherwise, just continue to use the ETF.
Thank you, ma'am. Now, the second question for today is, in your prime stocks, should I buy a stock only at the buy recommendation price?
No, you don't need to buy the stock only at our buy recommendation price. See, as long as a stock is in the buy list, you can buy it. So you can accumulate, over time. You don't have to do it only on the date on which we make the recommendation. See, our focus in prime stocks is, in any of our stock recommendations, is long term. It is on making returns through compounding the earnings. And we look at valuations, right? So as long as valuations are not completely out of sync with growth or growth, you can still buy it. We'll still be retaining it in a buy list and you can still be buying it. So there is no one single price at which you need. So, there are multiple prices at which you can buy a stock, as long as the fundamentals remain good, as long as the valuations remain good. If the valuations move out of sync with the prospects, then we will move it out of the buy list. We will take it out of hold and take it out of buy and put it into hold, or we might even issue a sell call if it's required. So in that case, so once it goes out of the buy list, you shouldn't be buying it, but as long as it is in the buy list, you can. And also because, sometimes stocks can correct. We would like all stocks to rally, but it will correct. So when it corrects, there will be additional opportunities for you to buy the stock. So it can correct even after a recommendation date. So, as long as it's in the buy list, you can buy the stock.
Thank you, ma'am. Now, the third question for the day, the final question for the day is, are tax-free bonds a decent option to be a part of one's portfolio, especially if one is in a higher tax bracket?
Good question. Theoretically, yes, tax-free bonds for someone in the highest tax bracket does make sense, because they will be a little more tax efficient. But the thing is, there are no new tax-free bond issues. So if you have to invest in them, you only have to do it through the secondary market. And when you're buying in the secondary market, you should be able to buy it at the right price. So, because the price determines the yield. The yield is not the interest that is being paid on the bond. The yield is a function of the price you are paying for the bond. So if you want to put it very, very roughly, if I have to give you a general idea, it is the interest divided by the price, which is what the actual yield that you are going to get on your investment. So because you're buying it in the secondary market, you will be buying it at the market price, which will change depending on the interest rate scenario. So given that currently we are in a low interest rate scenario, the chances are that you may be buying it at a higher price because it would have rallied. And because you're buying it at a higher price, it could be that because you're buying it at a higher price, the yield may be depressed. So you have to be careful. If the yield is depressed, you are locking into that lower yield for the entirety of the bond. So that may mean your returns are also going to be lower. So tax-free bonds are good additions to your portfolio, but only if you're able to get it at the right price and good enough yield. So you need to be careful when you are buying those bonds.
Thank you, ma'am. That's all for today. If we hope you have enjoyed this video. If you did, please let us know by liking it. Also, if you have a question, let us know in the comments and we will get back to you on that. Bye for now.